Before you say, what, the last thing we need is another Warren Buffett video on YouTube, this one is different. Why? Because I'm going to give you 4 very practical tips of what Warren Buffett is doing right now in the crisis, and it's the opposite of what he has normally been doing. So let's jump in. Strategy 1, stay liquid. Buffett is famous for saying our favorite holding time is forever. Why then is he selling out of so many of his companies right now? So here's a list of all of his trades this year. So far, Berkshire Hathaway has made a total of 44 trades, and of these, 36 are sales and only 8 are buys. He sold out entirely of Goldman Sachs and all of his airline stocks, and he's only bought one new stock, Barrick Gold, which is the world's second largest gold miner. So why did he do this? Because of strategy 1, stay liquid. In a bull market, stay long. In a bear market, stay short. But in a crisis, stay liquid. Right now, we're not in a bull or a bear market. We're in a canary market. The canary in the coal mine has dropped dead and things are about to get very bad. Warren Buffett is stocking up on cash like never before. And if you're thinking, wait, isn't Warren Buffett against cash? The answer is yes. He's quoted as saying, today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Why then are this month's news headlines shouting about Warren Buffett's $129.6 billion of cash in the bank? This graph shows how Buffett has added $100 billion to his cash pile over the last 10 years. So why is he staying so liquid when he doesn't like cash? Okay, this is why. That cash is terrible quote, that actually came from an op-ed he did for the New York Times way back in October 2008. That, by the way, was right in the midst of the global financial crisis. You can see the article here. It's the same one where he said, a simple rule dictates my buying, be fearful when others are greedy and be greedy when others are fearful. He could say that as the crisis hit because before the crisis, just like now, he was already piling up his cash. And now, like then, he knows the real crisis is right around the corner and he's getting ready to buy. And by the way, if you're thinking maybe he was just lucky to be piling up cash then like he is now, well, I went through the effort of reading his last 10 shareholders' letters over the last decade just so you wouldn't need to. And here are some of the highlights. From his 2007 letter, you may recall a 2003 Silicon Valley bumper sticker that implored, please God, just one more bubble. Unfortunately, this wish was promptly granted and just about all America came to believe that house prices would forever rise. You only learn who has been swimming naked when the tide goes out, and what we are witnessing at some of our largest financial institutions is an ugly sight. That was just before the global financial crisis really got going, and here's what he wrote in 2008. The period was devastating as well for corporate and municipal bonds, real estate, and commodities. By year end, investors of all stripes were bloodied and confused, much as if they were small birds that had strayed into a badminton game. The watchword throughout the country became the creed I saw on restaurant wars when I was young. In God we trust, all others pay cash. And then in 2009, as he got into his buying spree, this is what he wrote. Long ago, Charlie, that's the CEO, laid out his strongest ambition. All I want to know is where I'm going to die, so I will never go there. That bit of wisdom was inspired by Jacobi, the great Russian mathematician who counseled invert, always invert, as an aid to solving difficult problems. I can report as well that this inversion approach works on a less lofty level. Sing a country song in reverse and you will quickly recover your car, house, and wife. We will always arrange our affairs so that any requirements of cash we may conceivably have will be dwarfed by our own liquidity. When the financial system went into cardiac arrest in September 2008, Berkshire was a supplier of liquidity and capital to the system, not a supplicant. At the very peak of the crisis, we poured $15.5 billion into a business world that would otherwise look only to the federal government for help. We pay a steep price to maintain our premier financial strength, the 20 billion plus of cash equivalent assets, and remember they're at 6 times that right now, that we customarily hold is earning a pittance at present, but we sleep well. As a result of that liquidity, Buffett went on to make over $10 billion during the crisis. I'm seeing many people doing the opposite of staying liquid right now. They're buying property, they're buying physical gold, they're paying off their debt. Don't do that. Hold on to liquidity so that you're ready for the opportunities when they come. Strategy 2 is de-risk. How do you stay liquid while also hedging against the US dollar? Warren Buffett's August investments show you how. Buffett is famous for being anti-gold, and he said, gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. Why then did he just buy $500 million of Barrick Gold? First, because gold is one of the best hedges against the US dollar. And secondly, by buying into a listed gold miner, he's keeping liquidity while also earning dividends. As Stephen Innes, who's the chief global analyst at Axicor, said in this article, this is a continuation of Buffett spreading his international wings and diversifying away from the US dollar. Now, most of Buffett's investments are in the US, but they're for international companies like Coca-Cola that are earning in multiple currencies. And his very latest trade is all about de-risking out of the US itself. Warren Buffett's Berkshire Hathaway makes big bets on Japan. Berkshire Hathaway on Sunday announced that it has purchased stakes in Japan's 5 leading trading companies. The stakes are worth roughly 5% each and have a combined value of $6.7 billion based on the company's share prices on Monday. Berkshire said that it bought the holdings over the last year through regular purchases on the Tokyo Stock Exchange. So he's been doing this for the last 12 months. In fact, this comes after Buffett issued $4 billion in yen bonds a year ago. And if you're thinking, wait, wasn't that op-ed article that Warren Buffett wrote by American? I am. And the answer is yes, but there was also this article from 6 months earlier before the crisis actually hit. Warren Buffett buy foreign. Where back in 2008, Buffett was hedging against the fallen US dollar just like he is now by buying into foreign companies. So you don't have to have billions to do exactly the same. I did this video about how important it is to hedge against the US dollar, which has already been dropping this year. But if you're going to buy investments in gold, make sure they stay liquid. And it's easier than ever to buy into overseas investments. Otherwise, when the collapse happens, so will your assets. Strategy 3, play defense. In a bull market, always play offense, and in a bear market or just before a crisis, always play defense. Defense comes from what you invest in, or more importantly, what you stop investing in. Buffett has cut the number of companies he invested in from over 90 back 10 years ago to now just 43 today. That's a 50% cut. And of those 43, over 70% of his entire portfolio is just in 4 stocks. Why is it that Buffett just announced that he had $13 billion in stock sales in the last quarter, which include almost all of his banking stocks, Goldman Sachs, Wells Fargo, JP Morgan Chase, US Bancorp, and finance companies like Visa and MasterCard, but then he bought more shares in Bank of America? It's because of his ABC strategy. In 1993, Warren Buffett sat down for an interview with Super Money author Adam Smith, and this is how the conversation went. Smith started, if a younger Warren Buffett were coming into the investment field today, what areas would you tell him to point himself in? Buffett replied, well, if he were coming in and working with small sums of capital, I'd tell him to do exactly what I did 40 odd years ago, which is to learn about every company in the United States that has publicly traded securities, and that bank of knowledge will do him or her terrific good over time. Smith then says, but there's 27,000 public companies. And Buffett replies, well, start with the A's. Today, Buffett has got as far as A, B, C. I mean, literally. Over 70% of his $210 billion portfolio is in 4 companies that start A, B, C. A is for Apple. Buffett owns $91 billion in Apple stock. Remember him saying that he doesn't invest in technology? Apple now makes up 44% of his entire portfolio. He's seen his stake grow by $18 billion in this year alone, and he's now Apple's second largest shareholder. B is for Bank of America. He first saved Bank of America with an investment back at the global financial crisis, and he now owns $22 billion of Bank of America stock. C is for Coca-Cola. Buffett owns $22 billion in Coca-Cola stock as well, which is 10% of Coca-Cola and 10% of his portfolio. He also bought Coke for the first time during a crisis, which was in 1988, soon after Black Monday in 1987. The shares he's bought in Coke, $1.3 billion he spent, and now he's made a gain of $21 billion. Those 3 companies make up 63% of his entire portfolio. So after ABC, did he go on to D? Nope, he went back to A again. The 4th company is American Express, which he also bought in a crisis. 1963 was a salad oil crisis where Amex was in big trouble as a result of a scandal. Their shares dropped 50%. Buffett put in 40% of all of his cash to then buy those shares, and today he owns $18 billion of Amex. As we move into this crisis, many experts are saying diversify. Well, here's what Buffett thinks about diversifying. He says, diversification is protection against ignorance. It makes little sense if you know what you're doing. So playing defense is doing more with less. Cut back on your focus at a fewer number of investments. And by the way, I know some of you watching are going to be just starting out investments, while others are experienced investors and may even call yourself Buffett experts. But the problem is, when this crisis hits, as Buffett says, it's only when the tide goes out that you learn who's been swimming naked. And that brings us on to step 4, look foolish. For a lot of this year, Buffett's actually been criticized for not keeping up with what's been a crazy market. The same happened with the dot-com bubble before the crash and also on the lead up to the global financial crisis. 2 years ago in 2018, as you can see from this article, he was already preparing for the crash. He said, though markets are generally rational, they occasionally do crazy things. Seizing the opportunities then offered does not require great intelligence, a degree in economics, or familiarity with Wall Street jargon such as alpha and beta. What investors then need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period or even to look foolish is also essential. So be okay looking foolish. Just stay liquid, de-risk, and play defense. I hope this video has been useful. If it has, please give it a like. And if you're wondering what the timing is from where we are now to when we're going to have the next crash, keep in mind that the biggest two depressions of the last century, which happened in 1929 through the Great Depression and then also with the global financial crisis, they were both triggered by events in February of March of 1929 and 2008. There was a period of 6 months of government intervention from March all the way through to October when markets actually rose like crazy. And then in each case, there was a massive stock market crash in October. So whether or not timing is exactly the same or different this time, the most important thing is be prepared. In the last couple of months in our education companies, we've been lining up a series of acquisitions, and I'll be explaining more about what we're doing and how we're doing in upcoming episodes. So please do subscribe. And in coming episodes, I'll be going through tips, strategies of how to make sure you are weathering this crisis. Thanks very much for watching. Do post a message below, and I'll leave you with links to a few videos to make sure you're prepared for what's about to come.